Commercial banks. A commercial bank is the version of banking most people already know. It takes your money in, promises to keep it safe, and quietly lends most of it back out to other people. You deposit your paycheck and forget about it. Meanwhile, the bank has already loaned a large portion of that same money to someone buying a car, a house, or starting a business. This is not theft. It is the entire model. Banks only keep a small fraction of deposits on hand at any given time. People assume their money sits in a vault with their name on it. It does not. It exists mostly as a number, backed by trust and by the assumption that not everyone will ask for their cash on the same day. That assumption is called a bank run, and it is the one scenario commercial banks are built to survive, but never fully prepared for. A commercial bank does not store your wealth. It borrows your trust and rents it out to strangers. Investment banks. Investment banks do not deal much with everyday people. Their world is corporations, governments, and enormous sums of money moving between them. They help companies sell stock to the public for the first time. They arrange massive loans between corporations. They advise on mergers where one company swallows another. Every deal is measured in the millions, sometimes billions. People often confuse investment banks with the bank down the street, but there are no checking accounts here, no debit cards, no drive-through windows. This is a different world, built on advising powerful clients on how to make even more money. The danger lives in the risk-taking. Investment banks often trade with their own capital, betting on markets moving in their favor. When bets go wrong at the scale, the damage does not stay contained. It can ripple through entire economies, as history has shown more than once. Investment banks do not just move money. They move the fate of markets, one high-stakes decision at a time. Central banks. A central bank does not serve regular customers at all. It serves the entire financial system above it. It controls interest rates, decides how much money exists in an economy, and acts as the emergency lender when other banks are collapsing. When a country's currency needs protecting, this is the institution making that call. People assume a central bank simply prints money whenever it wants. In reality, every decision here ripples through mortgages, savings accounts, and job markets almost immediately. Raise rates and loans become expensive everywhere. Lower them and borrowing gets easier, but prices can start climbing. The unsettling part is how much power sits in so few hands. A handful of decision makers can quietly reshape millions of lives with a single rate announcement. A central bank does not manage your money directly. It manages the conditions your entire financial life depends on. Credit unions. Credit unions look like ordinary banks from the outside, but the ownership structure is completely different. There are no outside shareholders demanding profit. The members who deposit money are also the owners. Every account holder technically has a stake in how the institution is run. This changes the incentive. Instead of maximizing profit for investors, credit unions are designed to return value to members through lower fees and better rates. It sounds almost too fair to be real. But credit unions are usually smaller, with fewer branches and fewer digital tools than large commercial banks. Convenience is often traded for a system built around people instead of profit. People assume all banks operate the same way behind the counter. They do not. One version answers to shareholders. The other answers to the very people standing in line. Payday loan companies. A payday loan looks like a fast solution to a short-term problem. Someone needs cash before their next paycheck, and this company hands it over almost instantly. There is no long approval process, no credit check that blocks most people, just quick money, due back in full within weeks, along with a fee that sounds small on paper. That fee, translated into an annual percentage, can reach numbers that would sound illegal anywhere else. Borrowers who cannot repay on time are often offered a new loan to cover the old one. People think this is a one-time fix for an emergency. In practice, many borrowers take out loan after loan just to stay afloat, watching the debt grow instead of disappear. A payday loan does not solve a financial emergency. It often postpones it, with interest attached. Private banks. Private banking exists for a version of wealth most people never encounter directly. This is banking built for individuals with enormous assets, not average savers. Instead of a teller, clients get a dedicated advisor managing investments, estate planning, and tax strategy as one coordinated system. Minimum account balances alone can exceed what most households will ever save in a lifetime. People imagine this is simply a fancier version of a regular bank account. It is closer to a personal financial command center, built entirely around protecting and growing existing wealth rather than helping someone build it from nothing. The unsettling truth is how differently money behaves once there is enough of it. Strategies exist here that are never offered to an average customer, not because they are illegal, but because they only make sense at extreme scale. Private banks do not help people get rich, they help the already rich stay that way. Online banks. An online bank has no physical branch, no lobby, and often no teller you will ever speak to in person. Everything happens through a screen. Without the cost of buildings and staff, these banks often offer higher interest on savings and lower fees than traditional competitors. On paper, this looks like a clear win for the customer. But when something goes wrong, there is no branch to walk into. Every problem gets funneled through a support chat or a phone queue, and resolution depends entirely on how well that system is designed. People assume digital automatically means safer or more advanced. Security depends on the same protections as any bank, and a service outage can leave customers locked out of their own money with no physical door to knock on. An online bank trades brick and mortar for convenience and asks you to trust a login screen the way you once trusted a building. Shadow banks. A shadow bank performs many of the same functions as a real bank, lending money, financing deals, moving enormous sums, without operating under the same rules. Hedge funds, certain lenders, and some investment vehicles fall into this category. They are not required to hold the same safety reserves as traditional banks, which lets them move faster and take on more risk. People assume regulation exists everywhere money moves at scale. It does not. This is precisely why the sector is called shadow banking, operating just outside the light most financial oversight shines on. The danger surfaces when these institutions are deeply connected to the regulated financial system without being bound by its safeguards. A crisis inside the shadows does not always stay contained there. Shadow banks operate in the space between finance and oversight, where speed increases and safety nets quietly disappear. Development banks. A development bank exists to fund projects regular banks consider too risky or too slow to profit from. Roads, power grids, hospitals, and entire industries in developing regions often begin here. These institutions are usually backed by governments or groups of countries, not private investors chasing quick returns. The goal is long-term growth, not next quarter's earnings report. People assume this kind of funding is closer to charity. It is not. Loans still carry interest and repayment terms, even when the purpose is public infrastructure rather than private profit. The complicated part is what comes attached to the money. Development loans can come with conditions that reshape a country's policies, industries, or debt obligations for decades after the project is finished. A development bank builds infrastructure with one hand, while quietly shaping a nation's future with the other. Offshore banks. An offshore bank sits in a country different from where its client lives, often chosen specifically for lighter regulation, lower taxes, or stronger privacy protections. Some use is entirely legal, businesses managing international operations, individuals diversifying assets across borders. But the same privacy that protects legitimate wealth also attracts money that would rather not be traced. People picture this as a shadowy vault reserved only for criminals. Much of the activity is legal financial planning. What makes offshore banking controversial is how easily the same privacy tools can be used to hide wealth from taxes, ex-partners, or investigators. Governments have spent years trying to force transparency into these systems, closing loopholes one treaty at a time, yet the appeal of financial secrecy has never fully disappeared. Offshore banks do not just protect money, they protect the silence around where it came from and who it truly belongs to.